the company no longer plans to ramp up production of its new iPhone. Joining us now is Wedbush analyst Dan Ives. He has an outperform rating on Apple. $220 is the price target. Josh Brown is still with me. What do you make of this report? True, not? What does it mean?
I mean, I think, I know we talked about it with you. iPhone Pro, the mix is heavy, 85, 90%. And a year ago, that was 65%. So I think a lot of this is really more glass half empty in terms of what's happened on iPhone 14 base model. The street's focused on the Pro. The Pro continues to be, I believe, 8 to 10% higher than a year ago. And that's why I believe, this was an opportunity to buy this stock. I still think that they beat numbers despite some of these reports.
But, I mean, if they're not allegedly going to increase production, it sort of flies in the face, does it not, of a belief by you and others that there's going to be this super refresh cycle all through the system because of these new models, Pro or base model?
Look, I think at first glance, and you saw the reaction last night, in terms of what this news was, but as I handheld investors through it, I think when you go through the math, the mix shift on Pro is jaw-dropping. I mean, like I said, 85 to 90%. That's significant for ASPs. And I think production, what Apple's essentially doing is swapping to more Pro models before they overall increase production. The base, no doubt, it's been underwhelming, but I believe the street starts to understand the message. It's all about the Pro. That's the key for ASPs and revenues going forward, which is why I thought this report, in my opinion, it's sort of a glass half empty rather than telling the whole story.
Why should I believe that the so-called last general standing, if you want to put it that way, in terms of these mega cap tech stocks, right? Microsoft has gotten hammered. We know about some of the other ones, too. Why should I believe that Apple, its moment is about to happen on the battlefield? It's going to get taken out. It's just a matter of when, and maybe these are the first steps.
Sure, and I think it was viewed, okay, now the golden child, Apple, now they get thrown out and another sort of victim of the market. I mean, Scott, what I just continue to point to is fundamentally what's happening with our checks. I mean, enterprise cloud story with Microsoft, they're still a third of the way through that. And I think that's one overly negative in terms of whisper expectations from Microsoft going into the next year. Multiples already contracted significantly. And then I look at a name like Apple, it comes down to 240 million iPhones haven't been upgrading 3.5 years. That's going to continue to flow through. And I think also the China story continues to be underestimated in terms of the valuation here. And that's why I believe this continues to sort of be Rock of Gibraltar plays in tech, despite obviously a dark macro.
Hey, Dan, I look at every metric that you would follow Apple on, and it is more expensive than the median over the last 5 and 10 years. So just take a median trailing 12-month on anything you want. Enterprise value to EBITDA, price to free cash flow, price sales, price earnings. It's not only not only is it outperforming the S&P still this year, minus 15 versus minus 21, but it's held its overvaluation relative to all of the other mega cap stocks. So, is that outlook not truly in this valuation? For me, and I'm a shareholder, it really does seem, to Scott's point, that the risk is to the downside, not the upside at this moment in time, especially if we think this isn't a blockbuster phone.
Sure, and I think when you put those metrics together, totally understand the point. I think a lot of investors are there. I think where we differ in terms of our view that this has basically become, going forward, it's a sum of the parts in terms of on the services business, the valuation you have to give $100 billion annual business growing in the low to mid-teens versus what I would say is, call it the last 3 years prior to that, the ultimate services business was valued $300 billion. I believe that's worth 1.3 to 1.5 trillion. So that's really our view. It's a sum of the parts, and an overall PE misses the underlying growth that's happening in Cupertino.
That's fine, but that doesn't necessarily justify the PE being at 24 or 25 times when the overall multiple of the market itself is coming down.
Yeah, and Scott, to that point, I think like when I look at the growth of Apple relative to which they just say broader S&P, when I could look at services, what I believe is a massive pent-up demand on the iPhone, as well as just more and more products and more penetration coming forward, I could argue that Apple's growth could be double in terms of what a lot of other tech names, ultimately their growth prospects, especially in terms of large cap, are going forward. So that's why I just think straight PE to look at Apple, I think misses the underlying growth story. And that's sort of been our view with Microsoft as well, and some of the cybersecurity names like Palo Alto.
All right, the table pounder, as you've called it. All right, Dan Ives, thank you.